Excel accounting practice problem. Pay sales tax. Get ready because we're about to excel. Here we are in our Excel worksheet. In prior presentations, we put together the worksheet from a blank sheet, now continuing to enter transactions into it. If you have access to it, there's two tabs on down below, an example tab and a practice tab. The practice tab starting out where we left off last time. The example tab, in essence, being an answer key. Let's take a look at it now. So we're now going to be looking at paying off the sales tax payable. You'll note that as we've been increasing the sales with the invoices and the sales receipts type of journal entries, we've been increasing the sales and the sales tax up top. We're now going to be paying off the sales tax. The sales tax in the United States will be different from the state and locality. They also might have different rules in terms of the type of business and the revenue or the amount of revenue that is being generated as to how often you have to pay off the sales tax. We're just going to use a generic type of example here in that we're going to have this sales tax be increasing as it has been when we make the sales, and then we're going to be paying in the following month the sales tax that have been accrued or accumulated upwards in the prior month. So for example, we had month 1, which was January, sales tax going up. The sales tax continued to go up as we made sales in February. We're now going to be paying off the sales tax, but only for the month of January. So we've got to pay the prior months of sales tax by the end of the following month is the rule that we will be applying here. So if we go to the practice tab, then we're going to do the journal entry related to it. But first, let's set up our accounts here, do our cleanup work. We're going to hide some cells from the skinny column, going from the skinny all the way to column A to the skinny. Right click and hide those cells. Then I'm going to take my ending balances over here in the trial balance, making them our beginning balances. Copy those, put them over here in the beginning balances. Right click and pasting. The right click's not, I can't, there it goes. Pasting 1, 2, 3 values only. And then we're going to delete the stuff in the middle so we can focus in on this one transaction. Now the transaction's straightforward. It's basically like a check type of form. If you were using accounting software like a QuickBooks, it would basically be simply a check form, but it's a special check form oftentimes if you're using software, because software will often kind of help you with the setting up of the sales tax. In other words, when you generate the sales tax, when you put the sales tax in place, it can be complicated because you might be subject to different sales tax in different locations, and you might have a state tax as well as a local tax and so on. So you need to set up the items in such a way that it will populate properly when you make a sale and accrue the sales tax upward in the sales tax payable, that being in the form in accounting software of an invoice or sales receipt. And then when you make the payment, there's often like a kind of a widget in the software as well, which will help you to make the payment to the proper account and then pay the proper areas, which is just basically a check form, but you might use a special kind of widget to create that actual check form to pay off the sales tax. And so just be aware of that in, like a tax software system. But the actual journal entry is basically kind of a check form. So it'll look like this. We're going to say that we have on 2/28, we're paying the sales tax for January. The checking account would go down and the debit would be decreasing the sales tax payable. Like so, the debits and credits are as simple as that. The amount can be the most confusing component because we're not taking the full sales tax here. We're looking for the sales tax for the first month because we're paying the first month of January in February. Now, if you're running reports in accounting software, you can kind of look up reports that would be generating the sales tax by month or so on. We can, of course, look at our general ledger over here in the sales tax. So if we went to the good old GL, you'll recall that the prior month sales tax, we rolled up all the prior month balances to the beginning balance. So this beginning balance was the ending balance as of last month. This stuff that has accumulated in February, we're not going to pay until the following month in March. So we want to pick up that 2344 in essence. I'm going to go all the way to the left. And we could do that with a formula. We could pick that up. I don't think it will create a circle reference of any kind. If we wanted to do it that way, we can bring it on over and say, let's pick up that sales tax payable from right there. We'll say pick up the 2344. I want to make this one a debit though, so I'm going to double click on it. Going to put a negative in front of the B to flip the sign. And there's our debit, there's our credit. Easy as that. We're going to post it out, the sales tax payable, to the trustee trial balance down here in the liability area. We are in cell AC 19 equals. We're picking up that debit of the 2344, bringing the balance down to the 554. That should be the balance that we have had in the activity of February, us having paid off now the January sales tax that have accrued upward. The checking account up top then is going to be up here in the checking account AC4 equals. We're going to be pointing to that 2344, having the 103,378 in both the February and year to date. Same with the sales tax, same number in the February and year to date. Note, it's often confusing to people when you look down here and you see, hey, why don't I have a sales tax payable or sales tax expense, in the income statement accounts? Because I'm paying the sales tax. I'm being, in essence, charged sales tax. Why don't I have an expense related to sales tax? And remember the concept of that, the reason for that is that the idea is that the tax is not really applied on you as the business owner, that it's applied to the person purchasing the goods and services. You are just being used as the tool that the government is using. They're using you like a wrench or some kind of collection pickup, like a pickup stick agency type of tool, in order to take their money. So you're just the one that has to collect the tax and then distribute it to the government. But the tax, in theory, is actually supposed to be on the customer, the one that is purchasing. Therefore, the revenue never goes on the income statement when we make the sale. You'll recall, when we make a sale, we increase the sales by the amount that we charged the price, and then we increase the liability directly. Note that you could imagine a system where you could say, well, why don't I just increase the sales by the total amount we charge, including sales tax, and then expense the sales tax when as a sales tax, when we pay the sales tax, right? So then the revenue would go up and it would net out as a sales tax expense too, because we don't get to keep the money. We don't do that. And in theory, part of the reason we don't do that is because it's supposed to not be an actual revenue to us and an expense to us. It's not our tax. It's the tax to the customer. Therefore, when we make the sale, even though we're collecting more than the sales amount, we're not going to record it as revenue. We're going to record it as directly to the balance sheet account of that liability account. And then when we pay it off, we're not going to be, charging an expense account. There's no expense related to it because the revenue never hit the income statement. So neither the revenue nor the expense hit the income statement. It's just going in and out of the sales tax payable account. So let's go up top and post it to the GL now. So we got the GL. Here's our sales tax payable. Here it is on the trial balance. So it's the third to last account going all the way to the right. We're looking for the sales tax payable. We're in BM22 on 228. We're now in BN22 equals. We'll go left till we hit that wall. Boom, hits the wall. Scrolling up, we're going to that 2344 and enter. So now we're left with that 554. So that 554 is what we have accumulated this time. So these add up to, in other words, 554, the February activity. So that means that we're going to be left with the 554. That should be on the trial balance that we still have to pay off, which we'll be paying off in March. There it is. And we're out of balance up top by the 2344 until we record the other side right to the checking account. Checking account is going to be right here. We're in 228 again. And AH is going to be equal to AH15 equals left to the wall, picking up that 2344, bringing the balance down to 103,378. The 103,378 matching what is on the trial balance for both February and the year to date. So that's going to be it. This is where we stand as of this point in time on the trustee trial balance.